Hi, my name is Umo, and this is my friend Shida.
Oh, okay. How are you, Mochida?
Yeah, I'm fine. Okay, actually we're here because we plan to invest in construction company because we heard some rumors that saying construction sector are going up for next few years. So
Okay.
And we actually have narrowed down a few potential company, which are Gamuda Bhd and YTL Corporation Bhd. Can you tell us more about these two companies to us?
Oh, yeah, sure. I will
Ah.
find it. I will find the company overview.
Okay.
Okay, I will tell you briefly about the Gamuda and YTL corporation background. Okay, here's the company overview. Okay, as you can see there, both company Gamuda and YTL Corporation is a leading company in infrastructure and construction. Yeah, construction. And then it's major in property, in infrastructure such as doing the highway, doing the houses and all. And there's a nice cash there. So okay, I will tell you about the financial analysis here. So for this company, our first tool to financial analyze the two companies to make this our decision, it will be the ratio analysis. Ratio analysis is basically how it gives us a quick indication of the financial performance of the company. This ratio is an indication of the company's performance. We have different ratios for basically the ratio. Inside the ratio analysis we have different categories, just like the liquidity ratios. Under the liquidity ratios we have the current ratio and the quick ratio. Here we can see that the current ratio is basically, and the quick ratio must be over 1. It's like how liquid the company is in paying off its current liabilities. So here we can see that the Gamuda Bhd has been going on a downtrend starting from 2.6, ending up on 1.97%. While YTL is much more better, its performance is much better. It has been going stable with some fluctuation inside. So YTL is better here in terms of liquidity. On the other hand, we have the quick ratio. Quick ratio is much more for the on-spot payments. For YTL, it's not good because it's under 1. Basically, the quick ratio and the current ratio must be over 1. But here we will prefer quick ratio because it has been going stable throughout the years. Because just for Gamuda we can see that it started with 2.46, ended up with 184. But for YTL 0.53, 0.45, but because the fluctuation is very low, so our perspective we will go for YTL. Then we have other ratios, solvency ratios. So solvency ratios is basically calculate the leverage. How much is the leverage inside for the company? The debt ratio. The debt ratio is actually calculated by dividing the total debts or the total liabilities by the total assets. The solvency ratio measures the extent to which asset cover commitments for future payments for future commitments, just like the liabilities. The solvency ratio of for different companies gives different indications. For example, for an insurance company, it is the size of the capital relative to all risk it has taken. Basically, it ranges around between 0 to 1. A ratio of 0.5 indicates that half of the total assets of the company are financed by liabilities. A lower value of the ratio is better than a higher number. So here we can see that Gamuda is better than YTL because here we can see that 53% of the total assets are financed by assets at the same time, which is very risky because if your company cannot pay out its debts, it can be a problem in the future. We have different ratios, just like the profitability ratio. Here we can see the EPS for YTL is better than on the other side. We can see the other profitability ratios, just like ROA, return on asset for Gamuda is better than for YTL. For YTL, it has been going less and less and less. The same goes for return on equity. And the last year, both are going down, but for the last year, we can see Gamuda is still higher than and YTL, expect that YTL was higher than Gamuda in the beginning. So we can calculate, we can come out with a decision that for liquidity we have YTL less than 1 over here, the quick ratio. We can make a conclusion that Gamuda Bhd is better, even though the average collection period is higher, but still for profitability and the solvency ratios are better. So based on this, we will go for Gamuda Bhd. Now we start to analyze the companies through time value of money. For time value of money, we have some figures to look upon, which are the risk-free rate inside Malaysia is 3.77, which is the risk-free rate is basically the government bond rate. Beta coefficient is the company's performance up to the market index performance. So for Gamuda, we can see the market performance of Gamuda is better than the market performance of YTL. And now we have the risk premium. It gives us 4.01. So for Gamuda, we have a required return of 8.02, and for YTL we have 6.70. We will use these figures, so we will make some decisions on these two figures, which are really important figures for us. Now we will calculate the future value of both companies. We have the net cash flows, the required rate of returns. So we concluded that the future value for Gamuda will be this figure, and for YTL will be this figure. But for YTL, the future value is much better, or the growth of the future comparing to the present value is better. So our decision based on time value of money will be YTL. Now we will work on the risk and return part to analyze the companies and make a financial decision. For risk and return, we will use the CAPI model. The CAPI model is actually used to get the expected annual return from both companies. For Gamuda is 19.87, for YTL is 6.7, but the actual return on investment is only 3.78 for Gamuda. So there's a big difference between these two figures. So basically the investors will prefer going to a much lower difference. So based on risk and return, we can conclude that YTL will be a better option for investor, as the difference between the accepted annual rate and the rate on investment is much smaller. And now we will move to the bond and stock valuation part. So we will evaluate the company intrinsic value of the bonds, so we can know that whether they are overvalued or undervalued. We will use the dividend growth model here. For the case of both companies, we have calculated the current prices. So the intrinsic values of these both stocks. For Gamuda is 0.12. The market share price right now is 112, which indicates that the Gamuda Bhd is really overvalued. Investor would not like it. But for YTL, it is 8.47, which shows that the intrinsic value is really higher than its current price, which is 1.11. So the investors will like and prefer to go here. For Gamuda Bhd, we cannot find any bond in their financial statements, but for YTL, we can see that they have some bonds, but right now we have no sufficient information about their par values. So basically we can conclude that they are not issuing bonds right now. So there is no point of valuing the bonds, as we cannot invest inside the bonds. So for the stock and valuation part, YTL is still better than Gamuda Bhd. Cost of capital. Cost of capital is an important aspect of financial analyzing to make our financial decision on and the financial advice on. For cost of capital, we will use the WACC formula, which is the weighted average cost of capital. We will need cost of debt. For example, cost of debt measures how cheap we can get the loans from the banks, or so low cost of debt is better than higher. YTL is called relatively lower than Gamuda, which is good. For we will use the cost of equity, which is what was calculated previously through CAPM. And the other figure we will want is the market value. Market value of Gamuda is lower than YTL. Market value is basically the market value of equity plus the market value of the debts. For REX, we will need the tax rate. We will use the corporate tax rate, which is 24%. For REX, the weighted average cost of capital for Gamuda is higher than YTL, so here we can conclude that YTL is better than Gamuda to invest in. Right now, you can see how YTL is going better as a company to invest in than Gamuda. Cash flow estimation. Cash flow estimation is basically one of the good tools to make our decision on and give the advice. Basically, cash flow estimation is made to get these two figures, terminal cash flow and the operating cash flow. These are the workings for the cash flow. For example, the projected revenue for the upcoming years. Here we can see the projected revenue for YTL is in negative, which is not a good indicator. On the other hand, Gamuda, they have a positive 13%, which is really good. Continuing on. Our expenses in YTL, they grow a bit slower than in Gamuda, but if we come to compare with the revenue, Gamuda will be better. Then going for the depreciation. For the depreciation, we can see the rate of depreciation, average rate of depreciation in YTL is 6%, while on Gamuda is 3%. Alright, Gamuda is going well. For the change in net working capital, we can see Gamuda are doing really well. Their annual growth rate is about 9%, comparing to YTL, which is 1.9%. Big difference. Here we forecasted the current assets. We forecasted. Here we got the annual growth rate for current liabilities. We can see current liabilities are contracting in Gamuda, whereas in YTL they're expanding. Basically, this was because you can see it jumped from 6 to 12 because there was some here, and they are going down and down and down with the years. Change in net working capital, you can see Gamuda is doing better. Coming to the operating cash flows, you can see that their operating cash flow is expanding, whereas in YTL is contracting. Then going for terminal cash flow, we can see them. By the way, we use the tax rate of 24%, which is the corporate tax in Malaysia. Terminal cash flow is also expanding in Gamuda, and YTL is contracting. So for cash flow estimation, we can know that Gamuda is doing better than YTL. Now we will proceed by using the capital budgeting technique to make our financial advice and investment decision. Basically, capital budgeting is a tool or a process of evaluating and selecting long-term investments that are constant with firm goals of maximizing owner's wealth or the shareholders' wealth. So they are long-term investments which are constant with firm goals. So unfortunately, and we were short of any information regarding capital budgeting for both Gamuda and YTL Corporation. Bhd, we cannot find any relative calls or relative investments, so we will be short of using this capital budgeting tool for our financial investment advising. Now moving to the Islamic financial management part. In Islamic financial management, we will see whether the company is Sharia complement or not. So here we can see it's a financial tool or technique that this sees or evaluate the company is working on Islamic principle and values. What here we mean by Islamic principle and values, that they don't use uh, riba, or they don't involve in riba and gharar transactions, and on the same time they doesn't, as we are in the construction sector, they don't develop any non-sharia buildings, we can call just like nightclubs, casinos. So here we can see the ayah, whatever riba you give, so that it may increase your the wealth of the people doesn't increase with Allah, and whatever you give for zakat and seeking the pleasure with Allah, and God will multiply it. So basically, Allah is telling here is that what riba you get basically doesn't increase your wealth in reality. So for Gamuda and YTL, Gamuda through the Sharia Advocacy Council, we can see that Gamuda is a Sharia complement, so it will be safer for us. But on the other hand, YTL, as we had discussed before, it has some bonds. Basically, all type of bonds have been prohibited by the Majlis al-Fiqh. So our advice would be that if the investor is a Muslim, he will leave YTL and go to Gamuda. But due to the past techniques, we have shown that YTL performance is much better than Gamuda. We will conclude that leaving the both will be better. But um, but if the investor is non-Muslim, he will go for YTL. But being Muslim, he can invest in Gamuda, but he will face many risks. That's all.
So hoping for meeting you again next time.